Next panel is called DeFi at a Crossroads. Can decentralized markets win institutional volume? Moderating the panel is John Wu, who is president at Avalanche, as you guys probably already know.
Well, thank you very much to the TIE for hosting this great event. And if the answer is yes, if you put it on the Avalanche blockchain is the simple answer, so we can just go home now. But I've known a lot of you guys for a long time, and most of us have come from traditional finance before entering this space. And I've known Josh actually for close to 10 years. So why don't I start with you? Because you've had a great career going from Goldman Sachs to Circle to Kraken to everywhere back and forth. And now you're at Galaxy and now you're at FalconX. So how do you define DeFi from an institutional perspective? You've been on both sides of the fence.
Yeah, I was going to say, I would have had a better career if I went to Avalanche, right?
I gave you an opportunity.
That's true. Yeah, I mean, DeFi is a multi-layered thing in crypto, and it's kind of a nebulous concept, but I think there's at least a couple of layers that you can decompose it into. There's sort of a front end or sort of a way for users globally, right? The idea is it's completely decentralized, anyone can interact with it. It's a way to capture and aggregate a bunch of retail attention. There's a layer at least that market makers or liquidity providers can interact with that retail flow. And then underneath all that is some settlement layer, which is usually like the underlying base layer on which the protocol is constructed. I think that's generally like how you can think of any DeFi protocol. I think what we're seeing more and more is just the complexity of DeFi protocols is becoming, in a way, like a disaggregation of these layers, and everyone is sort of specializing in different things. For instance, there are a lot of firms out there that are solely focused on providing liquidity and sort of doing the CeFi, DeFi arb between on-chain venues and off-chain. And there's also a lot of services that are purely aggregators at the top of the funnel, capturing that retail flow and then figuring out the best way to route it and so forth. So I think from an institutional perspective, what we're going to see is the same thing that happened in TradFi, right? Which is basically like everyone specializing in their part of the stack, whether it's like the consumer side or the sort of like underlying technology to make everything more efficient and more secure and fast. And yeah, I mean, I think that all the protocols that we've seen more recently have been all of the ones that are successful, right, are basically like extracting some kind of value or implementing some kind of value capture at one of these layers. And the market's really rewarding ones that can achieve that sort of like revenue capture.
Sure. So what I've seen though, and I'm the biggest proponent of the merging of DeFi and traditional institutional products. Coming from traditional finance, I was a tech investor for the longest time. The issue I see though is that a lot of these real world tokenization things and stuff have been frankly just a digital twin or another wrapper of an existing thing that exists kind of pretty good well in its own world now. Dave, I know you have been providing your clients with yield because they can't access it, and you've got an interesting thing you're doing. I'll let you talk about it. Maybe you're trying to innovate in a different way within the confines of the existing rules. Maybe you can talk about that.
Yeah, I mean, our approach to DeFi is working. Our approach to DeFi is a little bit novel. It's working. Oh yeah, great. This one works. Good. It's loud. All right. So our approach is pretty novel. So Waves, most of our AUM and most of our revenue is tied to DeFi. We do operate out of the U.S. We're SEC regulated. We operate offshore for a lot of the more degen DeFi things we do. And you can largely think of us as, in a sense, kind of a market maker for large layer ones that want to basically put their own assets into their own DeFi. So our biggest set of client bases are a lot of the largest protocols in crypto. If you look at the top 25 tokens of the ones that have a treasury at least, we manage probably a majority of those now. And we refer to these funds as ecosystem support funds. So I'm going the opposite direction of as an institutional thing. What we basically do is we make DeFi better for layer ones by using their assets, providing liquidity, making sure applications can solve that 0 to 1 problem as new features are emerging, new applications are emerging. So it's a great business for us. And And yeah, obviously the panel before this was a treasury company panel, basically. So we are doing our own treasury play. It's a little bit novel. So we are taking ourselves public, not just as a treasury play, we're going out as an entire company. So our SEC regulated asset manager with a lot of assets, debt business, a lot of other businesses. So not just a treasury play, but we're leveraging what we do in DeFi. So the fact that we already do these yield strategies for a dozen coins, will be a dozen coin, think of it as like an index fund, but with a yield. So on the yield side, that's typically kind of 10 to 20% APY. So yeah, but then the challenges we see is, the top of this panel is where is institutions coming, and not to go too long, but one thing I was always kind of shocked about is we had a really interesting meeting with like Apollo, Franklin Templeton, and a processor ran back in 21. And at the time, they were shockingly good at understanding DeFi. This is 2021. It was not recent. They understood all about like how to optimize a curve pool, and we were kind of shocked, thinking like we were going to talk way over their heads. And we didn't. But the reason institutions aren't here is all regulatory right now. And one, there's a scalability issue also a little bit, but it's really just, DeFi is still a wild west. So,
Gregg, you were a former banker. Talk about what kind of volumes and what kind of size you really need to see before it takes interest in. David mentioned Apollo and those companies, and when you're 500 billion in assets, and a DeFi market, TVL is about 200 billion. What do you need to see for it to really happen pragmatically? Forget about the regulatory stuff for a second.
Yeah, so I think that as a banker originally, it ultimately comes down to collateral. And the more forms of digital collateral we have, the greater the productivity of these assets become. And so, with this type of audience, certainly in the Hedera ecosystem, we're really excited about, the incubation of projects that have been seed, Series A, and now coming to TGE. And so if you're looking for allocations, we'd love to have that type of conversation. But ultimately, whether they are, equity and VC type of assets or traditional wrapped assets, they are collateral for a variety of different functionality. That's what DeFi is about, whether it's swap, borrow, lend, invoice. These are collateral formats. And so when it comes to scale, what we've seen with conversations with large institutions, you look over the last several weeks, Aberdeen and Lloyds did a collateral mobility for their FX business. So two of the UK's largest financial institutions. And, they do on FX over 5 trillion a day. And so when you're talking about collateral, which is often, either a percentage, and in some cases in this industry, it's often over collateralized, you're talking about a absolutely massive innovation in being able to maintain investments in a vehicle rather than having to revert back to cash to meet margin calls or other transfers amongst institutions. So I think that the ability to tokenize assets, have them be a collateral format, really is the big unlock that we've seen play out in Bitcoin, of course. Those were the Bitcoin-backed loans that I remember originating back in 2016. And then they expand as the types of collateral grow. And that's really where I'm very excited about the present moment, because it's rapidly expanding.
So on that note, almost like on cue here, Thomas, I'm going to make you the most unpopular person at this conference, because when you walk through that hallway and you talk to people out here, half the people want to talk about DAT and the virtues of a DAT. You do a Bitcoin yield project, and you say that DATs are useless and they will have no value in the long run. So I'll let you explain yourself.
Hello? Okay. Yeah, putting me on the spot here. I would say right now we're in the accumulation phase. I think institutions are speed running crypto quite a bit, right? If this is the ICO phase. And very soon, faster than I had expected, probably by the end of the year, it's going to turn to what I view as the activation phase. So Bitcoin is no longer just like an ornament on the balance sheet, right? You're not looking at just as a reserve asset, but you need to turn into revenue. Also, by way of background, I've also had the pleasure of working with all these fine gentlemen on the BitGo side when I cover them at BitGo. So at BitGo, I ran sales. I was there for 7 years. The observation was last year, BitGo hit 100 billion in AUC. large majority of that was in BTC. So the question was, how do we actually get yield on this BTC? Because our clients were just paying, like 24 bips on it. And so I started to look at DeFi and how DeFi was evolving with Bitcoin-Fi, a lot of these interesting projects. And the more we kind of ideated on this, the more we started to see that, hey, Bitcoin is becoming a reserve asset for DeFi, but very quickly people need to put it to work just like they need to put cash to work. So I guess my view is with these DATs, the corporate treasury managers, CFOs, are going to wake up and start asking, hey, how do I put this thing to work now that I have it on my balance sheet? And that's what we're trying to solve.
What kind of yields can you get?
Yeah, so right now, the short answer is it varies depending on the type of risk you want to take. I would say if you want to go play the pure DeFi route, DeFi is not large enough. My unpopular view on DeFi is there's no real true DeFi yield for BTC because it's not a proof of stake asset. It's just incentive campaigns of large chains throwing money at it, making it look like yield, but that yield disappears in 30, 60, 90 days. Right now, Bitcoin still is the best pristine collateral asset to facilitate borrowing and lending. We have a wrapped asset. We have over 1.6 billion in TVL or AUM. We're just facilitating loans at this time. Over the next 12 months, hopefully we identify some more interesting, what I call high integrity strategies, but I have not seen any of those arrive yet.
Thank you. Josh, you've been in derivatives and you've done a lot of different cool stuff. Let's talk about structured products. Everyone says structured products is a natural place for really mass takeoff in the on-chain world. Do you agree? And what kind of structured products are we seeing?
Yeah.
For institutions.
I think if you look at some of the products that have gained the most AUM traction in the last couple of years, it's been effectively actively managed strategies that are tokenized in one form or another, right? Things like Ethena, USD. I think a lot of people want to put that in the stablecoin bucket, but it is in many ways like an actively managed strategy across different perps and spot collateral assets in crypto. And I think it's really just the beginning of a larger phase of products that appeal to retail users who want to generate, like we were just discussing, a way to get yield and productive use out of the assets that they're holding on chain. And the diversity of things that you can do on chain is going to keep growing more and more as there's more RWA and sort of even tokenized equities, tokenized equity perps, things like that on chain. So from our perspective, we think that's like the main driver of the next cycle. A lot of capital, I think, in the lead up to this, where we are today, which is at new all-time highs, has been, a lot of the capital has been recycled, sort of like money that's been in crypto for so long. I think a lot of money has left crypto, actually, right? Has gone to equities. And that's where really like the speculative animal spirits have collected in the last couple of months, certainly, with all the IPOs and the digital asset treasuries and things like that. The way that all that comes back into crypto is through these sort of like new assets or old assets being reborn as crypto native assets that you can trade, you can tokenize, and you can convert into sort of yield generating or sort of complex strategies that you can deploy on chain. One more thing I'll say is, it's not just, we're seeing there's a lot of strategies obviously in TradFi, like the MicroStrategy overwrite ETF, right? That is an asset, that's an ETF that has $5 billion in it. There's clearly a ton of demand for these sort of more complex yield generating strategies outside of just, like the native staking yield or lending. And as a lot of the markets in crypto get more efficient, those sources of yield are compressing a lot. And so the more complex strategies, as we all know, that this always happens in TradFi, they manifest in, derivative formats, in vol selling formats, things like that. We think a lot of that will continue to grow in crypto over time. I think the management of them will become more sophisticated. You all, I'm sure, remember last cycle, there was a lot of the option vault products on chain. A lot of those didn't survive the downturn of the last cycle, but in this cycle that we're seeing today, the products are much more well constructed. In some ways, the collateral is more segregated and secure. They're held in off-chain or off-exchange solutions and things like that. And at the same time, the management of these things is much more sophisticated. You have a lot of vault curators, like dedicated market-making firms that are putting their brands on these vaults, and the market can sort of like judge the reliability of these service providers. So yeah, there's much more of a marketplace for these things now, with a lot of credibility and reputation behind them.
There definitely is, and the vault service providers are creating a track record that's great. And we've constantly throughout the line here talked about yield, and a lot of this yield in the structured products depends on a curve in contango on the perps. So, David, how do you generate yield if the curve is flat?
Oh yeah.
Share a microphone. A lot of different ways. So we have a pretty complicated, mousetrap now that does these yield generation strategies. We do this again on, a lot of big chains, but also on a lot of chains that don't have very large TVL, and which is art all in of itself. And a lot of it is, we live in a lot of LP pools, transaction fees. There are a lot of incentive tokens, still being thrown around in those pools, which is certainly helpful. And most of our technology now is around impermanent loss mitigation. So we have, everything we do has very active CeFi and/or DeFi, hedging strategies to make sure that while we're picking up this yield, we're not getting run over, by the token price movements and whatnot. So it's hard to do. It's something we're completely specialized in. I think we're very novel in it, in the way we do it. But the yields are there. Like the yields actually are pretty decent still. DeFi volumes are going through the roof. We're doing a lot of, this is actually the lowest yield stuff we do. We're moving a lot of RWAs on behalf of our clients in. Like, I would argue that half the time you see an RWA announcement, that's us in the background. For regulatory reasons, we don't really yell it from the rooftops or anything. But, so those are the lower yield things. But you can make, 10, 15% yields in DeFi if you know what you're doing and you have the right apparatus set up and you have the right risk monitoring systems, which is probably the hardest thing we've ever had to build. How do you actually monitor all this across all these chains, all these small dApps? How do you trust the data, to use your auto extractions and things like that? So it's an interesting world. Yeah.
Thomas, in your Bitcoin yield product, my assumption is some of these are OG people who just never want to get rid of their Bitcoin. And if it's an OG person, all they think about, crypto native people only think about reward. They don't really understand risk. But can you talk about some of the risks they are taking, the unconventional risks, by doing Bitcoin yield that they should be thinking about?
Sure. So I'll split a demographic more between sophisticated versus unsophisticated investors. The sophisticated investors probably like the Waves, right, or the FalconXs. They have their own teams to manage the risk. So they're not really looking at on-chain vault type products because they can just internalize it, run it themselves, and get probably similar returns without having to pay the performance fees. Unsophisticated investors, you're right, they're either longtime OG holders or they kind of live inside a cold wallet or maybe in a retail platform. The way that we solve that for them is actually so to be clear, we ourselves do not have a product. We're just a distribution layer today. Eventually we might have a product, but today we do not. What we're trying to do is we're trying to build the simplest UI layer. So today, as we exist on Bybit, the user just sees Bitcoin, 2% APR, 45 days, and a stake button. That's it. They don't even know it's us in the background. We've abstracted away the complexities. We have the legal agreements in place. Once they hit stake, what we're actually doing is we're actually minting our asset, which is the ERC20 wrapped version of the BTC, deploying that into certain vaults, certain strategies. That's returning the yield, and then we give it back to the users. So our whole game is, I think we need to decomplexify or simplify a lot of this stuff that's happening, because we're just exiting a world in DeFi, especially in Bitcoin, where you had like 25 vaults and 500 different points programs, right? Like, no, I want people to just see like 3 vaults, very simple English. They know exactly how the returns are done on chain, so they have full visibility. So they know what chain's done on, so they can evaluate the smart contract security risk. They know our tech stack, so they can evaluate how the Bitcoin's being secured. And of course, the strategy, whether it's through which specific dApp, right? Aave, Euler, Compound, we've heard of those, or is this some up-and-coming dApp? So we want to be operating all this on-chain in clean, simple strategies.
Gregg, what kind of trends you're seeing on your chain that you're super excited about?
So I think that, we've talked a lot about yield here, and that's a maybe second order benefit of the tokenization or digitization of an asset. And so the conversations that we at Hedera have had with large organizations typically evolve first around a regulation or regulatory compliance. So ensuring that there is OFAC compliance as an example, ensuring that there's KYC, ensuring that there is not embedded front-running risk or maximum extractable value within a protocol selection. I think when it comes to a chief compliance officer of a large organization that's saying, all right, we're going to digitize or tokenize our funds, there's embedded risk in many of the protocols. And so it's addressing those concerns. And then it really gets down into the scalability and distribution, right? We, as I mentioned, in terms of the, the daily UK volume in the 5 trillion range of FX for Aberdeen and Lloyd's, that has to be heavily scalable in order to even scratch the surface of those types of volumes. And I don't think that as an industry we have yet really cracked the distribution side. And so whether that is via retail or institution, that is one of the challenges that I expect to see a lot of focus on over the coming months and change, frankly.
Josh, earlier over there, you told me that you feel like the perp market's going to explode in real-world assets. Now, I have a couple of questions related to that. A perp market, for those in TradFi, it's kind of like a hybrid between a future strip and a swap. It's but the yield's done daily. But in traditional commodities, you have a storage cost, you have treasury yields, your risk-free capital, and obviously the supply and demand for the out months, all that stuff. So how do you get the inputs to have a proper contango in a perp market? But before you even get to the real-world asset side.
Yeah, I think us and probably a bunch of other market-making firms have gotten a lot of requests for comments from different regulators on this topic. And I think, the gist of it is crypto has really innovated ahead of TradFi here, right? Like, we've created a new product that has really gained product market fit and a lot of traction, especially for retail users. And the current regulatory environment isn't well adapted to enable that for traditional assets and traditional markets. So we're ahead of the curve, and in a lot of ways, crypto is good at letting the market figure out what the right price is, right? And so perps are effectively that. I'm sure you guys are generally familiar with the mechanism. There's a asset that is a derivative that can float above or below the actual underlying price, and depending on how much it fluctuates above and below, it determines the funding rate or the cost of holding that instrument, such that it forces the derivative to trade back to the spot price. And it's quite clever in terms of its construction, and it's very similar in many ways to like a rolling short-dated future strategy. So even in the absence of thinking about what the underlying asset is, or whether it's RWA or crypto, there is a very well understood mechanism in crypto for these types of instruments and pricing them and trading them, and they are now amongst the most liquid instruments in the world in all kinds of assets. So I think we're ahead of the curve in terms of that. And when it comes to putting new types of assets on chain, I think there is a huge opportunity here, and the opportunity is there's not a lot of firms that can touch both traditional markets, like for instance have the ability to operate as a broker dealer and trade equities and get be able to short without a locate and all that kind of stuff, and then people who can actually touch DeFi markets and maybe have like the right compliance frameworks in place to be able to operate there. So if you are one of those firms that can operate in both realms, it's a huge opportunity, and we hope to be one of them that has the flexibility and sort of the we are actually a highly regulated firm ourselves. We're a CFTC regulated swap dealer. So that is something that we are very focused on, and making sure that our regulators are comfortable with everything we're doing. At the same time, they're also clearly pushing for innovation in this area, and they're soliciting feedback from their market participants to enable this new product that we've created to be available to the broader market and retail investors in TradFi.
I got the under 5-minute sign before us, so I'm going to ask one final question and maybe a follow-up for every single. I'll just go down in order. What's your biggest prediction for now and year end, Thomas?
People have been talking about DATs that I've been hating on them, so I'll continue to hate on DATs, I suppose. I think it's going to be, the market's going to be reacting punitively for people who just hold Bitcoin on the balance sheet and don't put it to work by the end of the year. It might be trading at a discount.
Interesting. Okay.
Yeah, this is kind of a broad one and maybe somewhat consensus, but I think tokenized equities and sort of like perps on equities and even prediction markets, like anything that's related to real RWA or real world events are going to drive the next cycle, meaning like I think that's the narrative that retains the most capital.
By year end?
What?
By year end?
By year end, I think, yeah, I mean, we're seeing a lot of founders like really focus in these areas.
RWAs are already happening very slowly. You think it's going to drive the market going forward? Like, let's define this, because
I think it's the narrative, yeah, for the rest of the cycle.
The narrative, okay, that's just like a cop out. Like, you got to give me something more. You got to say it's going to drop like 50% of the volume. It's going to do this.
Okay, so here's maybe something more actionable. Like, if you think about all the SPACs that are raising right now, there's billions of dollars going into these deals. A lot of them have mergers that close towards the end of the year. So call it like 3 or 4 months from now. That capital is going to be deployed close to the end of the year. So that should be very supportive for crypto asset prices.
You're a public market guy, no front running. Isn't it anticipated?
Public information.
Okay.
That's right.
David, your turn.
Yeah, I mean, I think, we talked a lot about institutions not being able to operate in DeFi a whole lot. Yeah, that doesn't change, I think, the overall narrative that just DeFi is just exploding right now. And I think by year end, I think we're 30% away from the all-time like 2021 high of 180 billion or something like that. But, I think we'll hit that end of this year for sure. I mean, I think the RWAs will be a big part of it. Yeah, the yield is not super exciting in crypto terms, but these are non-crypto people. We spend a lot of time focused on the 75% of the planet that doesn't have bank or brokerage accounts, and all this, the Genius Act, everything else going through right now is just going to supercharge everything.
All right, I want to stop you right now because that's the weakest prediction I ever had. 180 billion TVL, like we're almost at 200 already. So give me something else, Dave.
By year end, I think we'll hit 300. Does that help?
Just threw a number out there, but that's better.
I did just throw a number out there. No, I believe that though. I think it'll double before year end. I think we're just seeing the beginning of so much in DeFi that's really kicking in. The treasury companies won't hurt. But
okay.
So
Greg,
I'll take
you got to have something real. You're an ex-banker, so I expect some numbers behind your prediction.
Here. So here's my contrarian view: is that on tokenized stocks, it's going to take longer than this year, but ultimately the crypto.
That's also so weak.
Well, okay. I'm getting there, but the crypto exchanges that have both the combination of retail clients that also have digital asset wallets are going to be the distribution channels that are going to overtake the existing wirehouses or distribution as these assets are tokenized. I think that's the natural progression. But before that, what we will see is that RWAs that exist on a variety of different chains will ultimately be sold and the chain will be abstracted. And so they will go and be sold to traditional investors, with those investors not caring the same way that everyone does today what underlying protocol it exists on. And I do believe there will be winners. And I think some of those winners are on the stage. And that's what I'll say for this year.
So embedded in that answer was a couple of predictions. One, I heard it's going to be a multi-chain world. I agree with that. I also think I heard you say something. What was your first prediction? You actually said something about how... Oh, yeah. You basically... I think you actually said... Effectively, what you said was, we're going to go to a wallet-based company over account-based. That really, I think, that's a bold prediction, but has zero chance by end of the year, if ever. But we haven't ended yet because of BTC here. What's the price of Bitcoin by the end of this year and next year?
I feel like anything I'm gonna say, you're just gonna counter.
No, as long as you have good math behind it, I won't counter. I used to be a TradFi. I believe in real numbers.
You know, I'm always a picks and shovels guy, so I don't know if I have a strong view other, than the prevailing view of it's going to continue to go up. Maybe more interestingly, it's just on the yield side, how that could evolve over the course of the next 12 months. And I think that with the Genius bill passing, we're living in a programmable economy now, and that opens up a lot of opportunity to use Bitcoin as the next potential yield infra. So I'm predicting that we're going to get north of 5% steady state Bitcoin yield in the 12 months.
That's a heavy yield. But your Bitcoin prediction, I could just ask Grok 4 or even 3 would have been better. Josh, Ethereum, where's that going to be? By year end and next year.
6K. And 10K.
Why?
Why? Well, yeah, I mean, I think that one, it's still pretty under-owned, like relatively speaking. Like it's been distributed a lot, and it's one of these things that is still below all-time highs, right? I also think that these treasury companies are doing a fantastic job of capturing these MNAV premiums and converting them into buy pressure. So I think as long as prices are up here, those types of vehicles create this like virtuous feedback loop for the price.
Yeah, well, Tom Lee was earlier on stage saying he's going to be buying every 20 days, so that helps your cause there. David, where's Avalanche going to be by year end and next year?
It's a great question, John. I think I'm very bullish on what you guys are doing, obviously, not just because you're our moderator and you can cut me off. The real world asset play makes a ton of sense. I think you guys have underperformed bluntly a little bit until very recently. So I think reversion to mean, you guys will do really well. I think you should double by year end.
At least, thank you. Well, that's all we have for today. No, I'm just kidding, Gregg. I'll end with you, the easiest one. Where do you think you guys will be by year end and next year?
We're playing the prices right. What I can tell you is that the momentum for this industry is continuing. I love to see it, and that will benefit us all.
Gregg is also saying, I wish I was still a banker because those guys are making so much money on fees right now with all these DATs, in spite of Thomas's comment. But thank you very much for attending, and again to Josh and Natai, it's a wonderful experience.